So accounting is the most basic function in business. As individuals, we're probably used to single entry accounting. That's what our checkbook looks like when we pull out a checkbook, if we used to back in the old days and write checks before the debit cards. But that's called single entry accounting. Double entry accounting is what businesses use. For every transaction, there has to be an equal and opposite transaction. If your cash goes up, that's a debit to cash. I put money in the bank. There has to be an equal and opposite credit. So revenue is a credit, liabilities is a credit on my financial. So if one transaction happens, there always has to be an equal and opposite transaction. And sometimes it'll take multiple impacts on another account to balance that transaction, but transactions always have to balance. So, so we start with the transaction, right? We write a check out of our checking account, and we will have to record that transaction. Those transactions go in what's called journals. So a journal is an accounts payable journal, then it goes to a ledger, and then we end up on the financial statements. So every company has two financials. It has a balance sheet and an income statement. So the income statement usually lasts for 1 year, whether it's a calendar year or a fiscal year. Many businesses are on a fiscal year. Maybe they are a ski resort, and their busy season is January through April, and so they might end their fiscal accounting year on April 31st versus businesses that ended on December 31st. There's no right, there's no wrong, and it's all over the board. Sometimes they end in July, June, you never know. And a company, depending on their seasonality, can pick whether they're going to be a fiscal year or an accounting year entity. So accounting principles, that's generally accepted accounting principles is GAAP and Financial Accounting Standards Board. It's the set of standards and record keeping that businesses have to use to recognize revenue. And do you recognize revenue on the day you receive the check, or when you do the work and create an invoice? And larger companies have to follow generally accepted accounting principles, and even small companies. We all have to follow a set of rules so that we can produce financials that we can share to investors, banks, etc. And most small companies are cash basis, as where larger companies and governmental entities are typically accrual basis. And the IRS has some regulations on the size of the company that makes them cash versus accrual. So continuing concern concept number 2, most businesses, you just assume that they're going to continue on forever. Companies that have audits, the audit firm, the CPA firm, will attest to a company's going concern concept. Sometimes they'll look at financials when they're doing the audit, and they will make a judgment that this company won't stay feasible. And that's a really negative audit assessment, and they write this big letter, and companies who have to present their financial statements to banks. And if they got a negative audit, if the CPA firm said, we are worried about your company's ability to be a going concern, that would be a really bad thing. Maybe they're facing bankruptcy. So the time period concept is, again, it's an annual period where revenue and expenses are recognized. It's 12 months. Again, fiscal period can be any time frame versus an annual period, which ends on December 31st. The cost principle is the cost of assets that are measured when cash is spent. So if I buy a case of paper for $10, my cash decreased by $10. I had an expense that increased for $10 because that's what I actually spent on it. If you're buying something large like a building, it may be valued or for sale for $1 million or $2 million, but you buy it for 500,000. That's the cost principle. It doesn't matter what it was valued, it's what you paid for it. So personal opinions about something's value, because we get really emotional about, oh my God, I love that building, I love that car, I love whatever. And it has a high emotional value, but we don't record emotion when it comes to accounting. So the matching principle, again, we talked about that. Expenses, revenue, liabilities must match the period for which they are incurred. So if I incurred expenses today, like payroll expenses, our main one that we're really interested in the PRA. So when we pay payroll, it's cash basis, and my expense is based on cash. So employees get constructive receipt of their paycheck on Fridays. So you would, under cash basis method of accounting, record your payroll expense on Friday. If you're accrual, there's a little calculation that we'll get into where you match your expenses when they occurred, not necessarily when they were paid. The realization principle is a realization of when you're going to record revenue. And again, cash or accrual, are you going to realize it when you made that deposit in the bank today? Or are you going to realize accounts receivable when you perform the work? And consistency, if you are a cash basis company and your tax return is done cash basis, it will stay cash basis unless you convert to accrual basis. And if you're accrual basis, you keep everything accrual and you don't go back and forth. So a chart of accounts, typically speaking, cash starts with 100, liability starts in the 2s, equity 3, revenue 4, expenses 5, overhead 8. So these are general. It just gives you a scheme to look at a set of financials and a chart of accounts. All accountants generally do the same method, that if a client has an account number that starts in the 1 series, it's an asset account. So assets are things like cash, accounts receivable, investments, inventory, fixed assets, building. Depreciation is also an asset account, but it's what's called a contra account to fixed assets. So as fixed assets depreciate, because things wear out over time, and the IRS tells us how fast or how slow we can take depreciation on our assets. And so if I looked at my chart of accounts at my asset and my depreciation on fixed asset, they kind of equal 1, because as 1 decreases, my fixed asset decreases, my depreciation on those fixed asset increases. Goodwill and intangibles. So if you purchase a company, like we've talked about purchasing a building, but goodwill relates to, say, a company, and say it's really highly valued, like Amazon is more highly valued if you were going to purchase it than some other company. So the actual assets of Amazon may not be as much as a company is worth, and you build goodwill over time. So liabilities are things like accounts payable, payroll taxes payable, wages payable. So as we record payroll transactions, we may not have to pay the taxes on our employees' wage expense until maybe Friday. Everybody was paid on Monday or Tuesday or Wednesday, and then we put the taxes that are due to the state and federal agencies in an accounts payable bucket until we pay them. And then and that would be a credit. Wage expense is a debit, credit the payable. And then when we pay those taxes, we're going to credit cash, we're going to reduce our cash and debit our accounts payable. Accounting periods, again, monthly, quarterly, or annual. And depending on the size of the organization and the audit period, but typically when people compare their income statement, because that's a period in time, a balance sheet is more stable because you don't buy and sell assets every day. So it's the income statement that fluctuates year over year that you want to compare. Month to month, year over year, you're going to look at your income statement and compare that your revenue was the same for 1 month, 1 quarter, 6 months, or a year over the prior year. So we talked about a balance sheet. So every company has two things. They have the balance sheet, which is, it stays pretty stable. I mean, your cash is going to change. Maybe your accounts receivable is going to go up and down based on your sales. Inventories can fluctuate, but typically you do account. Everything goes into cost of goods sold on your income statement. And you do inventory, sometime an inventory audit, and get the actual value of your inventory at the end of your fiscal or calendar year. Again, prepaid expenses, sometimes these are entries that are made at the end of the year when you're preparing your financials and you look to see what you might have prepaid. Because typically property, plant, and equipment, they don't change very often. Again, liabilities show up on the balance sheet. So this is when I said everything has to balance. So you've got your assets, you have your liabilities, and then you have your equity. You see the 3,563,800, my assets plus my liabilities and stockholder equity, they match. So which account is listed on the current liability of the balance sheet? Go ahead and answer that. And if I didn't cover it well enough, let me know. And I can go back and answer questions. Oh, I'm gonna look in my chat. 1 sec. Let's see. Accrued taxes. So liabilities are listed on the balance sheet as current liabilities, and those that need to be paid this year are current. So long-term liabilities. So if you have a mortgage on a building that says it's 10 years, on January 1st, the company would record the current portion into current liabilities and leave the other 9 years in long-term liabilities. And as an auditor or an outside investor in a company, you always want to be sure that the company has enough cash flow and ability to pay the current liabilities this calendar year. So there's some financial ratios why we have stuff in current liabilities versus long-term liabilities. And payroll taxes would be a current liability because typically It's going to be a very short because you're just accruing the taxes possibly on your current payroll because you haven't paid them to the IRS or the state. So the income statement is typically for a period. So again, it's going to be for the month, quarter, year, and that's where you record your sales, your expenses, your utilities. And I'm going to say they don't ask many questions about financials on the CPP. I think you might have to record the journal entry for payroll, and we'll get to that. And Rebecca and Kate, is that what you recall too?
I had actually had several questions on making journal entries and then knowing what side things would go, whether it's a liability or an asset, and whether they would go on an income statement or a balance sheet. I was
Okay.
surprised.
That is surprising.
Mm-hmm.
Mm-hmm. Okay. So again, the income statement is a period of time. So you have your sales minus cost of goods sold. And so depending on the company, if you're a manufacturing company, oftentimes labor expense, wage expense is a portion of the cost of goods sold because it took manpower, energy, and effort in order to make a widget. And so if you're manufacturing a widget, part of the cost of that widget is your payroll. So account classification, and we did talk about accounting, double entry accounting for every transaction, you have to record two sides. And we talked about the balance sheet, and we looked at that it balances that our assets equaled our liabilities plus equity. Our income statement consists of our revenue minus our expenses equal our net income. So if we look back over here, we've got our revenue. These are expenses. They're just different types of expenses, right? We've got our cost of goods sold, which we may have to buy cement or wood or lumber and mix it with wages to get a cost of goods sold to make a widget. And then we have expenses for general and administrative. It's like the receptionist in the office. Selling expenses could be cost of conferences or salespeople. They're not actually used to make the widget, so they go into a different expense account. And then again, depreciation on our equipment, and that has an impact on our balance sheet as well, because when you record depreciation here, you have depreciation less depreciation. You take it off the income statement and you record it here. So you have two sides of the entry. So depreciation is an expense, which is a debit. So you have to credit this account. And then you have kind of non-business things. Interest income, it might be on your checking account. If you're a big company and you have some of your cash invested, you're going to have interest income. Some companies record income on accounts payable that if you pay it early, you get a discount. That is a form of income. And then you've got provisions for income taxes. So whether you're a C Corp or an S Corp depends how you make that provision. If you're a C Corp, the actual corporation is taxed for income tax purposes, and then you get your earnings. So the net income for the year on December 31st, when the year closes, the income goes over to the equity section of your balance sheet. And if you're a publicly traded company, if you follow anything on stocks, there's an earnings per share. And so if everybody follows GAAP and generally accepted accounting principles, we can all look at financial statements and compare one company to the next because we're all following the same rules. And there's been a lot of movement in the past 10 years to make all countries follow the same rules so that you can compare a company, a foreign corporation with an American corporation. So journal entries, when we're recording the journal entry for payroll, we're really working, typically, we're going to credit cash because that's an asset. We are going to decrease cash and we are going to increase with a debit our expense account, our payroll tax expense, our wage expense. So if the only thing we did was record on a cash basis our payroll, we're going to debit wage expense, payroll tax expense. Equal would be a decrease in cash and it would be a credit because we're paying the cash out of our account and we're paying, just say, the payroll taxes all on the same day we're paying the employee's payroll. So a journal entry would record wages, record deductions, and they would be a credit to a liability, a current liability, until you pay them. So you write a check for your child support or you write a check for your 401k. You would record those as current liabilities. So a journal entry example. Okay, so we're recording an off-cycle payroll. We forgot to pay an employee. So $1,000 we're going to pay him and we have to record that entry. So we are going to debit our salary expense because expenses have a normal debit balance. And if I was looking at a journal, I had maybe $1,000 from my regular payroll plus this $1,000. So my salary expense journal would now say 2,000. And if I'm like totally losing you guys, let me know. And because it's an off cycle, and I'm going to hit wages payable. So to record the taxes that was deducted from the employee's paycheck, because maybe I'm a monthly tax filer and I don't have to pay the employment taxes today when I paid that employee $1,000 off-cycle payroll. So from that employee's paycheck, we deducted $120 for federal, $50 for state, Social Security was $58.28, Medicare was $13.63. So I owe those taxes to the tax agencies. So if we look over here on my federal income tax payable, I'm recording all of those taxes and the employee share of health insurance as liability because I need to pay them later at some point in time. And so if I were to look on my balance sheet, because that's where my liabilities are at, go back a few slides. Oh, so my balance sheet has my liabilities right here, current liabilities. All of those taxes are going to be sitting here until I pay them. This is a credit. Okay. So the company also needs to record the employer's share of taxes. So the employer had to pay their share of Social Security and Medicare tax, unemployment, and state unemployment. And again, we're recording a liability on our balance sheet, which is a credit that we're going to pay later. Wage expense is a debit. So I increased my wage expense, and wage expense is on the income statement or the P&L. If I go back a little bit, income statement is either it's going to be in my cost of goods sold or my general and admin expenses, because this is a debit. My debits increase my wage expense. So I've recorded the expense to the company. I've recorded the liability as a credit on my balance sheet that I need to pay later. It's a liability. And then when I actually pay the employee, right? Once I take his wages minus his share of taxes and deduction, his net paycheck is $698.09. So if we look here, we put a credit to wages payable down here, this $1,000, because we had $1,000. We put it here. Part of the $1,000 we moved, and we and we created credits to liabilities that we owe later. And then we paid the employee. So when cash leaves your bank account, it's a credit to cash. So if you just, pick up your right hand and point, it leaves. It's a credit. It's the right hand. The credits are on the right, debits are on the left. Many people get confused when you say credit to cash and it reduces your cash. That's because people get confused when they go to the bank and they go, I deposited my paycheck and they credited my account. It gets really confusing because that bank is saying, yep, it's a credit to your account, but it's a liability to the bank. So you've increased their liability. So it can get really confusing when people start talking about in the accounting world, inside of a business, when your cash reduces because you paid somebody cash and it's a credit. So if you can remember that, don't think of your bank because it's a liability. Tax deposits for the off-cycle payroll. So up here, we created liabilities, right? And now we're going to pay them. We're going to log into EFTPS. We're going to log into the state of Colorado, the state of New York, wherever, and we're going to pay these tax liabilities that have been sitting on our balance sheet. And we're going to pay them here. So I have to offset. So I had $120 of federal tax, 120 bucks. So it was in my liability account as a credit. We're going to relieve that account. We are reducing that account. So we are debiting it. And look, we're sending money out of our account for the amount of those liabilities. So again, we're reducing my cash account with a credit. So I know that's a really confusing topic. So who has questions? I can't believe I made it that clear. Nobody has a question? Wow. Okay. So again, we've really talked about the matching principle, that everything that has a debit has to have an equal and offsetting credit. It just does. Otherwise, it doesn't work. You've added something, you've misclassified something. An employee earned $12,000 in commission during the fourth quarter. This amount will not be paid until the following quarter. The journal entry for this is go ahead and put it in chat. And I'm going to say that the terminology was probably a little bit misleading because they have debit accrued salary expense. And again, I think it's a trick word, just like in many of their examples. You are accruing it because you're not paying it now, you're paying it later. And it could be just a label on a general ledger account so that they could track it because it didn't actually happen, right? They're accruing it to pay at a later date. So debits go with expenses. Credits go with a current liability. So accruals, this makes life incredibly fun. So typically, large companies, companies that are audited, governmental entities accrue so that they get the matching principal down. So when wage expense occurred, when the employee stood there and made widgets, you accrue it in the month, or you expense it in the month that somebody actually physically worked. So that's what an accrual is. And many entities that do accrual accounting, let me look one, I show my desktop, 1 second. I was going to put together a little spreadsheet for you guys. Here it is. Can you guys see the spreadsheet? And I closed part of my Zoom, so I need a verbal.
Yes.
Okay, all right. So when we talk about accruals, and if we had a bi-weekly pay period, it begins on a Sunday and it ends on a Saturday, and it's paid maybe the next Friday. And let me try to bring up my PowerPoint again. Wait, 1 sec, sorry. Might have to call Manny and come help me. Back. I had too many things open. Yeah. So when we get down to the end of the month and say this in blue, it's their second biweekly pay period, but it's actually paid in the next month, say December. So there are wages for this work week that need to be recorded in November. So you record an accrual so that you can properly match expenses in the month that they worked. And then at the beginning of the month, you reverse that entry. So companies do it with wage expense, utility expense, interest expense, etc., so that the financials are for, March has 31 days. So you've got 31 days of interest recorded in that month. So that's when people do accruals so that you can match the expense, even though it wasn't paid, your cash reduced here, that you have to record the expense in the month that it happened in. So that's what accrual accounting is. So that happens with vacation, PTO, etc., because you have to record the potential liability, which is a credit on your balance sheet of expenses that might happen in the future. So as your employees are earning vacation and PTO, you have to recognize that expense, right? Maybe they get 0.233 hours per whatever, 1 day a month, whatever it is. And if you didn't record that liability on your balance sheet that you owe that money to your employees at some point in time, your financial statements could be misleading, especially if you have a lot of employees. Your current liabilities or long-term liabilities could be understated, and people wouldn't know that, hey, you owe $1 million in vacation to your employees. So as you earn it, you accrue the expense. As the employees earn PTO, vacation, you recognize the expense in the month that it occurs. And then you put it on the balance sheet that you're going to pay it at some other date and time. And then when the employee actually takes vacation, you can reduce your accrued liability payable. You're going to credit, or you're going to debit this payable because you're going to reduce it, and you're going to credit cash because you gave them money. Pop quiz. Which one of the following journal entries is posted as a debit? And let me bring up my chat. Give everybody a minute. So cash is an asset that sits on the balance sheet and it increases by a debit. Expenses sit on the income statement and they increase by debits also. I know there's questions. There has to be a question. Oh, I can't hear you, man.
Just trying to absorb and wrap my brain around it.
It's
Trying to
remember.
absorb and wrap my brain. Is
I
it
can tell.
always like an expense increases? So an expense is a debit and then the balance to that is a liability increases. So that's your credit.
Yes. Yep, pretty much. Because if I have an employee making $1,000 and he's only going to get $500 net pay in his pocket, right? My expense is a debit on my income statement of $1,000. That was his wage expense. So the $500, so we got $1,000. We know $500 was a credit to cash, because we know if we point our right hand, that's a credit. If we point our right hand out the window, it's a credit, right? Cash leaves my account, credit. And I should turn on my camera so I can show you my and movements. So there's $500 between the $1,000 and the $500 he has in his pocket, right? And if I know my $1,000 is a debit, wage expense is a debit, you can just write that down. Wage expense, debit. Everything else has to be a credit. So if he had, $300 in federal taxes, that is a current liability, right? If he had $100 to child support, that's the current liability, because I owe that money to somebody else. And my debits have to equal my credits. So if I had a sheet of paper with a line drawn down the middle, and I had $1,000 on my debit side, which is my left-hand side, right, of the line, everything that I put on the right-hand side has to be credits. Make sense?
Hey, Angela, I
Yeah.
want to add one thing that this is a topic that people who are taking the test may want to practice, like with those T accounts, actually drawing the T and doing that debit and credit side, because you do have to actually make out these journal entries on the exam. So.
And I always do. Right?
Mm-hmm.
And we do this a lot here, right? Oh.
What is an example of a liability debit? So a decreasing liability.
When I pay it. So, yeah.
So accrued taxes.
So if you worked for me and I owed you $1,000, that's a debit to payroll tax expense. And my liabilities are payroll tax accrued. Federal withholding. I owe $200 to federal payroll tax through state. And remember, my debits and credits have to match. So then I have cash, right? Because your check was $700. I paid you. Right, my cash decreased. And this is, so that's how my debits
Tax is
and
an
credits.
asset.
Cash is an asset, right? But I'm decreasing my cash. Right? If I were to look at my cash journal, and this is a journal. Debit. I looked at my bank account and I had $5,000 in there, right? And I paid and I credited it, right? So now my cash balance, and let's just go like that, is plus. So my balance in my cash account is a debit because I paid you $700. So cash left my bank account. And it's a credit. Right? And
Yeah.
then if I have my taxes payable, which is a current liability, and I have my federal and my state. So if I look on this journal, because it's like a separate like journal piece of paper that I'm recording this on. I owe $300 from your $1,000 to the state agencies. Okay, so I'm gonna pay those. I'm gonna go into my checking account and I'm gonna write a check for $300. So now I only have, oops. Now I only have $4,000 in my checking account. And so this is now zero, right? Because I have relieved all of my liability because I put $200 from that I owed, that I deducted from your paycheck. And I put it in my liability bucket. And when I paid it out of my cash account, I wrote a check out of my cash account. I have to match my debits and credits, right? And cash left my account. Just always know, if I write a check out of my cash account, it is a credit. Always, 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 always. And so if I had a credit and I know I have a credit, I must debit something else. I'm reducing this liability because I'm paying those. My offset on my credit is a debit. That help? Or did I confuse you more?
It helps.
Okay. I'm going to say the key to my life as a CPA, if I'm reducing, everything goes to cash, right? If I know where my cash sits, cash is an asset on my balance sheet, so it has a natural debit balance, right? If I have cash in my bank of $1, I have a debit on my balance sheet of $1. And if it leaves, if I get my checkbook out and I give cash out, it has to be a credit. And if you can remember where your cash account is, that cash has a natural debit balance, liabilities have a natural credit balance, expense, if it increases, it's a debit. And if somebody's working and you pay them, expense is a debit. This is an income statement account. These are balance sheet accounts. Okay. All right. So reconciliation's huge. Everybody should reconcile their journals. So this is your journal. Each one of these would be a journal, right? I have a cash journal. I have an accounts payable journal. So you should reconcile your subsidiary journals and ledgers, and always reconcile your bank accounts. It's huge. Reconcile to general ledger accounts again. Yep. Internal controls. Huge. I'm going to say we did a seminar a few years ago and we've got one coming up with Steve Hovland about fraud and payroll and how frequently it happens by people who happen to have control and access over payroll. They make fictitious employees.